Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alcana, along with Brianna Valesky, and we have Chris Martenson on the line. He's an economic researcher and futurist. He's joined us on the show before. Chris, how you doing this morning?
I'm doing great. Good to be back, Joel and Brianna.
Thank you. Got a great connection here. Well, we're not quite at the end of earnings season. We're winding down here a little bit. Can you talk about the earnings so far, the earnings cycle, and the reaction by the market?
Well, the market reaction has been to go up whatever the news. I think we're looking at three consecutive quarters now with year-over-year earnings per share declines, and that's according to FactSet. And it's pretty rare to see a market going and powering back up to just under all-time highs with that kind of earnings per share behavior. So I guess the market is looking for either more Fed stimulus, more corporate buybacks, or thinking that maybe stocks still are the only game in town.
Yeah, and I mean, it seems like what about the stocks that had real high expectations for something like like a Facebook? It beat, but still got punished a little bit. I mean, is it that just the trend here with the stocks for this quarter?
Well, this is interesting. We're finally seeing what I consider to be a little bit of reality creeping back into some of the stocks out there, where we're noting that, yes, earnings do matter, and the earnings have been very low. The social media shares in particular have gotten hammered, but many of them turned in pretty dismal reporting, and I think Facebook is sort of caught up in that general view right now that maybe social media's the bloom is off that rose.
And how about the sector rotation? Kind of out of the momos, like your Twitter, obviously, and then some of your old names, your Alcoa back over $14. IBM didn't react great to the report, but has been rallying. It's just kind of going back to the old conservative stuff.
It seems that way, but I got to tell you, as we look at both trailing and forward earnings, stocks are very, very richly valued at this point in time. And so then we have to wander over onto the macro side, look at where GDP is going. Obviously, very weak first quarter at just 0.2%. According to the Atlanta Fed model, looks like maybe we're going to come in under 1% for second quarter. All of that's very weak, and none of that's really supportive of rich stock valuations. So I guess there's a little bit of maybe this time is different. I'm wondering if people are drinking the same Kool-Aid they were back when we were counting eyeballs in 98.
Okay, they'll always getting different opinions on that. But with the punk data that's been coming out, the Fed talking about not raising interest rates. I mean, you're seeing some signs in the market that someone's worried about interest rates going up here. Your TLT has come off a cliff on a major support level here. Conversely, you've had your TBT rallying nicely. What's going to give here with the Fed and interest rates?
Well, it's interesting. I think if we wander over to Germany for a second, we look at their 10-year bonds, and those are obviously still very low by historical standards, but the yields have shot up quite dramatically, at least on percentage basis. So somebody's out there worrying about interest rates at these levels. We're starting to see a little bit of action in the bond market that's suggesting that, yes, somebody is starting to worry about interest rates rising. I got to tell you, Joel, I don't think it's based on the Fed raising rates, because we all know that when the Fed raises rates, it's going to be the most widely pre-anticipated event in all of history. It's going to be a quarter point. That'll have been priced in a long time earlier. There might be something else going on here. It's starting to look, smell, and feel a little bit like a liquidity issue that is maybe going to join up with reality at some point in time.
You sounded kind of bearish to me, Chris.
Well, I'm a big reversion to the mean kind of guy. We are really in stretch territory, both in terms of time and also with respect to price on this particular move in equities. So, yes, a little pullback, I think, would actually not only be a healthy thing, but the longer we have to wait, the more it might be actually a dramatic thing.
Well, I mean, where's the mean here? I mean, I've heard that term used by, a lot of people, and, I kind of use it myself. I mean, with the way this market's been pulling back and rallying, I mean, let's say basis, the S&P 500. I mean, where's the mean at? I mean, I guess it all looks over what time period you're looking at.
Well, I guess, I'm going to really focus on corporate profits, which, have been just absolutely spectacularly elevated, coming in between 10 and 11% of GDP. Much more normal historical mean is around 6%, which means we're looking at a 40, maybe 50%, close to 50% decline in corporate earnings. That would be taking us back to the mean. The only argument you can make for corporate profits staying here is that we are now going to enter a new normal where corporate profits can be something they've never been in all of our country's history. They are now at 10%. That's the new normal. For that to work, Joel, what we need is very robust future economic growth, which I'm not seeing, obviously, in the current data. But when we wander over to oil, I don't think we're going to see it again for a long time.
Okay, that's what I wanted to move on to next. I believe you were on our oil show back when crude was under $50, made that multi-year low. Is making a nice rebound. It's just a counter rebound and a counter trend move in an extremely bearish market.
Well, I'll tell you, oil is one of these really tightly balanced markets. Maybe a million and a half extra barrels per day was enough to create the perception across the world of a global oversupply. But as I mentioned on that program back then, oil has to go back up at least to its marginal cost of production, which is still at least $20 higher than where it currently is. I'm looking at WTI, over $60 a barrel right now. First time it's poked its head there in a while and stayed. So this makes a lot of sense to me. Where the EIA, anybody who's tracking those numbers, is going to be disappointed because the EIA misses their production forecast because they use a lot of models, they use a plug factor, they miss turns. Clearly, when you look at the more specific state data coming out of Texas, coming out of North Dakota, they've been seeing obviously pretty good declines in the amount of oil output because the drill programs really stopped on a dime.
So why does it have to go to $80?
Because that's what it costs to get out of the ground. We look at the shale operators, all the biggies. You might want to look at Whiting, Goodrich, Anadarko, any of the big ones. When they were going through that period from 2010, 11, 12, 13, oil is over 90 a barrel, sometimes over 100. They were still burning cash in a huge way, negative free cash flows that were extraordinary. They were spending $1.50 to get $1 of revenue. And the idea was that you would be able to, at some point, stop that little treadmill, and now you have a cash cow. Well, we run the numbers, and none of these companies are actually solvent at anything less than 80 a barrel. That's for their current production. I think they need 100, 110 actually to be break-even companies.
Yeah, but I mean, I mean, what do you think? You think they're just going to start cutting the production until it get backs up to that levels?
Well, whether they decide to cut or not, the drill programs are such that if you are not constantly drilling, your production will fall off. Remember, these shale wells deplete 70% in the first year on average, 85% over the first 3 years. So if you had 1 million barrels per day of drilled production in just 3 years, you have 150,000 barrels. So what we need to see is a continued drill program. Now, if they are not continuing to drill, their production will fall off. If the Bakken stops being drilled today, in 1 year, it has 47% of the production that it had last year. It's an astonishingly rapid decline rate. So these companies need to keep drilling. If they can't justify it with price and they can't justify it with cash flows, they're going to need some other impetus to drill. That's why we're going to have to see oil prices go up. And I'll tell you, I think that it's going to be slower building up this time because there will be some accidents. There's going to be some junk bond defaults. There's going to be a few bankruptcies. There'll be some consolidation. And we're going to discover that these shale plays were not really making money before. We're going to have to be smarter about it. The companies are going to be smarter. They're absolutely containing costs. We're going to see it on both the the servicer side and the driller and producer side. Everybody's focused on cost. This is a good thing, but we're going to discover that these shale plays were actually more expensive than we thought.
Okay, and you did talk about the fracking last time we were on, and you said I remember thinking about it in the back of my mind. It was kind of where I was trying to develop a bullish thesis that these walls are not really sustainable. They go down. They're vertical. They go in. They don't have the ability to go in different directions to retrieve more oil. Is that kind of what you're seeing happening now?
Well, all the major shale plays require the horizontal drilling. That they've got fantastic technology. They do really good work. But I was just talking with an engineer from one of the major oil companies that did pull out of the shale plays because they discovered that they just couldn't make it work, and not with their capital structure. And also, this person's private opinion was the shale plays were deeply, deeply oversold, overhyped. Now, they're not complete dogs, but you have to be more careful. Everybody wildcatted. We had it was a free-for-all out there. Not everybody did it right, did it well. Now we're starting to understand who did it better than others. There's good stuff there, but it's going to take much higher oil prices, I think, to really justify fully diving back in.
We've been on the line with Chris Martenson. He's an economic researcher and futurist, joining us on the show, talking about what he's looking for in the equity markets. Really appreciate it, Chris. We'll talk to you again soon.
Thanks, Joel.